PF.
Hello and welcome to Financial Planner. We take another step in our learning curve, and this time we are talking about what are the different kind of issues that are there for you to participate in equity market and so on and so forth. And of course, as always, we would be wanting and more than happy to take your queries and address your basic questions, and helping us to address that and to guide us through is Jayant Pai. Jayant, thank you so much for joining us. We've been talking about various public, the entire issue, what is an issue size, etc., and other things with regard to a particular equity issue that we talk about. Now let's go deep down in terms of understanding what are the different kind of equity issues that can come out and how they differ from one to the other in terms of their role. First thing first, let's talk about IPO, a very commonly known phenomena in the equity market, the initial public offering, which means a company that is wanting to come to the capital market or to the stock market and offers its shares for the first time, right?
Yeah, that's right. In fact, this is just a new term for what we used to know as new issue in the olden days.
Okay.
So it's basically what you said. The company wishes to raise some money for some project, and they want to approach the outside public, that is the outside investors. So they do this through an instrument known as the IPO, which is nothing but shares which are offered to the investing public. They may be retail or institutional.
Okay. Now let's go back to another basic point that I have. A company which is not in a market or is not public in the sense that is not being listed, etc. So you basically still have your shareholding that is there. So your promoters own and some other entities, etc. And then you mutually decide that a part of this share I will be diluting, or you add additional capital. How does it work?
See, an IPO, one form is when the company raises money. The second form of an IPO may also be in the form of an offer for sale. Here, like what you said, a concentrated group of shareholders. It may either be the promoters selling a part of the shareholding, or there may be private equity investors who have been with the company for the past few years and who now wish to unlock the value. So they may desire to sell the shares. So they can do this through the IPO mechanism, but the proceeds will not flow to the company. In such a case, it will flow to the selling shareholders, whosoever they may be. Okay.
So there are two ways. If you're looking at offer on sale in an IPO, it essentially the money that is collected goes to the company promoter or the shareholder who is wanting to sell those shares.
Yes.
Then there is another part of raising capital. So when they raise capital, they issue shares.
Yeah.
Right? Explain that process or procedure.
Yeah, so when there is an IPO where actual funds are going into the company, you will see the number of shares increasing in the company. That is, the issued capital goes up. In an offer for sale, that's not the case. The issued capital will remain the same because it's only a change of shareholding within the existing number of shares. So when you have to issue new shares, there are a lot of more disclosures that a company will have to indulge in. So the process of the regulatory process is longer and more onerous, simply because SEBI desires that whoever is coming in, gets the maximum amount of information to make an informed decision.
Okay, now tell me something very briefly. When we talk about the fact that the company is coming to raise capital, now it can be for various purposes. It can be for putting that capital into the companies and for its further, either day-to-day growth, or it could be for expansion, or what could be the other purposes that one is coming to the public forum, because that also entails a whole lot of disclosures, whole lot of procedures that company has to follow.
Yeah, broadly it is what you mentioned. And the quality of the project or the reason why the company is taking money, that will help in making the issue attractive. For instance, if a company comes with a vague objective that we will invest for growth, that is not good enough. A company has to state exactly what it will do with the proceeds and what is the timeline, by which they plan to deploy the proceeds. So, and also there is a thing known as promise versus performance that you will have to write in a subsequent, especially for an FPO, a follow-on offering. So where the company will have to state that when they made the IPO, what were the promises and what they have done, I mean whether they have lived up to it or not.
Okay. While we'll discuss, the issue price, the other aspects of an IPO in our subsequent shows, let's go a little bit on the step-by-step process. So basically, the company decides that it is looking at, coming out or raising capital in the capital market, right? So it lays down its objectives, its reasoning, its entire what is the company all about, what are the plans for the future, and so on and so forth, what kind of, the promoter's background, etc.
Yeah.
It first appoints a lead manager.
Yeah, they are termed as investment bankers nowadays. In the olden days, they were called merchant bankers. So basically, they assist the company in two ways. One is in ensuring that they comply with all the regulatory requirements, and second is they help in marketing the issue. And even the price of the issue, in the olden days, there was an institution known as the CCI, Controller of Capital Issues, which determined the price. Nowadays, it is market determined. But that the reference rate or the reference price is determined in consultation between the company and the merchant bankers, and they then approach the market and then they test the market as to whether it is willing to accept this price or not.
Okay, so once the managers decide, etc., your entire issue basically goes to the market regulator, SEBI, who looks after the draft red herring prospectus, which is basically a content. It's a long, huge, heavy content in terms of various things that the company has done, where it comes from, what is the business that it is pursuing, what are the other avenues, what are the legal cases that probably the company is embroiled with, the promoter background, so on and so forth. Okay, so that is what your DRHP is. The market regulator takes certain time to sort of, if at all it has any queries, to go and approach the merchant bankers that and raises the questions to them. Once regulator says go ahead, or the time frame of 30 days or so, or whatever the time frame is to decide, within which it has to send the observation, gets over, what happens then?
Yeah, once SEBI gives the go ahead, you are supposed to come out with the issue within 1 year. This used to be around 6 months before, but now they've extended that. So, because if SEBI gives you a go ahead, it is based on what you have mentioned in the DRHP currently. If you use the same DRHP to come out with an issue after, say, 3 years, it will not be really correct, because a lot of material changes may have happened. So there is this time barring of this of the go ahead, so which is 1 year right now. But for certain other institutions such as banks, there is a thing known as a shelf prospectus.
Okay.
So by which once SEBI gives the go ahead, they certainly have to come out once, but all subsequent issues, they need not undergo the same onerous procedure.
Okay.
But this is restricted only to a few institutions, usually important financial institutions. Like in the olden days, we had ICICI Limited, IDBI, all these, where there is some government holding, but government holding is not a necessity. It basically, basically financial institutions continuously have to come to raise capital, because their raw material is money.
Okay.
So for such institutions, there is this little bit of relaxation known as a shelf prospectus.
Okay. Now, once we've gone into specific about the financial institutions, but I'm just saying that in terms of coming back to the point when we say that the market regulator has not objected to anything, you are basically then going on and you do your road shows, etc., to understand and say that you fix a time period of your issue opening. Then post that there is a listing which decides based on the price that and the subscription is decided. There are different categories. You have your retail investors, you have your qualified institutional investors, and various financial institutions, etc.
Right.
So this is as far as the IPO process is concerned. And considering this show is dedicated to the retail investor, what are the few things that one as a retail investor needs to do before deciding upon getting into an IPO? Because it looks at an attractive proposition, and mostly people do want to get into at an IPO level. But what is it that retail investors should be wary of, should really look into before investing in an IPO? Very quickly.
I think retail investors are minority shareholders, so they have to look at the company's track record in terms of how they will treat the minority shareholder. It is easier said than done because the company is approaching you for the first time. But what you can do is say, look at the litigations that they are involved in. You know, what sort of litigations? I mean, or is there any public interest litigation against it by any shareholder or any other stakeholder? For instance, a customer or a banker or anyone. So there are some subtle signs that you have to note before this. But what I feel is that you can also rely on the IPO reviews given by reputed publications and channels.
And the rating agencies as well.
Yeah, the rating agencies do rate IPOs, but that is more from, I mean, I would not give too much credence to that. Although, yeah, it is a ready-made benchmark that you can use. But I think like there are, I would rather go by the reviews of certain reputed publications, like I won't name them, but most of the channels and the and important financial publications, because they do a lot of groundwork before recommending.
Okay.
So,
okay, well, you know, Jayant, on that note, we'll take a short break, but this is discussion that will continue going on. We'll come back and we'll tell you what are the other public issues that you can look into, participate, how does that work. We'll be back in just a bit.
The Financial Planner, presented by the Bombay Stock Exchange.
Welcome back to Financial Planner. We were discussing about various public issues. We've touched upon IPO quite extensively in our previous segment, but now it's time to look at other public offerings, FPO, follow-on public offers. Jayant, very quickly, what are those and what are the options that investors have?
yeah, so these are usually offers of companies already listed on the stock exchange. For example, ONGC is in the news currently. So there normally the price at which the issue is usually linked to the current market price prevailing. And also you have two options. One is a rights issue, which is wherein the shares, the fresh shares are offered only to the existing shareholders in a certain proportion to the existing shareholding. For example, 1 share for every 2 shares held. Okay, so those shareholders have the right to either subscribe, or they could even, if they refuse to subscribe, they could sell this right to an outsider. So companies prefer this actually, one, because the disclosures are less, because since it's an offer to existing shareholders only, and second is that the
and it would be cost effective also, is much cheaper rather.
Certainly, because no hardly any marketing costs involved, and also the existing shareholding pattern can be retained.
Okay.
And this is very important for promoters.
Okay. Okay, and a little bit deeper on preferential issue.
A preferential is an issue to a concentrated group of shareholders, unlike a normal issue which is called diffuse set.
Yes.
So
okay.
here either the promoters may raise their own stake through a fresh issue of shares to themselves, or they could sell some new shares to a strategic partner. So this is known as a preferential allotment. Now because that new now this may be done even to thwart a takeover attempt, because if the promoter feels that their shareholding is too low, they may allot fresh shares to themselves and raise their shareholding percentage. Now SEBI has come out with certain preferential pricing guidelines so as to prevent this group from having any undue advantage. So the normal pricing guideline is the highest of two things. One is the price, average closing price of 26 weeks prior to the board resolution and authorizing this private placement, or the price 2 weeks prior. So 26 weeks or 2 weeks, whichever is higher. The price is a floor price. You cannot issue shares below that.
Okay.
Higher the better.
The better. That will be there. Well, Jayant, on that note, we'll cut short in terms of the FPOs are concerned, because that's something we'll be discussing even more in detail going forward. But I have a very important query which I'll be taking of one of our viewers based on, you know, the show Kumar Anand has sent us this mail. He's basically wanting to understand few basic concepts, and this was during the course of our show, and therefore I think it's important because to address the questions of our viewers.
Sure.
First thing that he's asked about is that when we say that BSE or NSE is at say 16 to 87 points or 5 to 98 points, what does it mean? So essentially he's saying Sensex at 17,000 level, Nifty at 54 level, 5400 or 48 going down, or etc. What does that mean? It's basically the value of index, right? Yeah,
it is the absolute value of the index. But what is this in relation to? It is in relation to a certain base year. Like for instance, the Sensex base year is 78, 79, 97, wherein the value of the Sensex is 100.
Okay.
So today if it is say 16,000, the Sensex has grown by 16 times. in this period. Okay, so but obviously people are more interested in the day-to-day changes. They are not really concerned about that. But basically this means that so if for instance the Sensex, the BSE changes the base year from 78, 79 to say 84, 85, their entire Sensex figure will look markedly different.
Okay. And it also gives a reflection of where the markets are heading, whether it's going up, whether it's going down. It's just a sort of a benchmark.
It is a proxy for the market overall movement.
Okay. Yeah. Next question is that what is commodity or commodity market? We've not dealt with that in detail, but essentially to sum it up, a commodity market is the market which deals with various commodities, whether it's gold, silver, and not just precious metal, but other aspects, whether it's, you know, your food grains, etc., that is being dealt with. So that's a commodity market. As a word of caution, we can say that it's a market which is essentially not really a retail investor market. I'm not talking about gold and silver, but a commodity market is more for the traders than a retail investor. Would that be correct?
Perfect.
Okay. Now let's go to the other part, which is what is upper cap, mid cap, low cap shares of for companies.
Okay. Now again, these are relative definitions. Like there will be different brokers and different research houses having different definitions. But primarily, suppose you rank all the companies listed in the stock market or on the BSE in the order of their market capitalization. Market cap is nothing but number of shares into the current price. So you rank them 1, 2, 3. So usually Reliance, Infosys, all these will come on top. And down there will be a long tail of small cap stocks with market caps of 100, 200 crores. Now, some brokers and some people, they have absolute cutoffs. Like all companies above 10,000 crores market cap, for example, will be large cap. And others will be mid and small. Some have a relative definition, like the top 70% will be large cap and others will be less. So it depends on whose definition you believe in.
So Mr. Anand has another question, which I will probably not take at this point in time, which is about what are various types of mutual funds, etc., because that's something we will, Mr. Anand, be discussing in great depth and detail in our coming episode. So you need to watch the show to get more ideas about that. As far as your large cap, small cap issues are concerned, that also will be going, while Jayant has almost addressed every bit of your query. But if you still have any, please do feel free to write to us any point in time. We'll take a short break and we'll take the query of a viewer. We'll be helping him with the portfolio when we return.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Let's straight go ahead and address the query of a viewer who's Pradeep Kumar Mahato. He is basically into offline trading since last 1 year. He says he's changed his mode to online. He wants to invest about 1 lakh rupees. He says one day I make profit, one day I lose. Goal is to achieve 60 to 70 lakh at the earliest, and wants to know how or where should he get the details about predicting intraday and delivery calls. So first thing first, he wants to make maximum money as soon as possible. Your views? Essentially, it seems that Mr. Mahato is not really is an investor, long-term investor. He's looking at being a trader, and at the same time he wants to make only money, which is not always the case.
Yeah. So I too was like Pradeep. I mean, I did try this thing for 15 years, and when I failed, I realized there have to be some better ways of doing it. So first, what I would like to tell him is that there is no shortcut. And if he is looking for so-called rainmakers who help him, who give him tips to earn money, that's easier said than done. There will be dozens who will give him tips, but there's no accountability. So it doesn't make sense for him to put his financial future into their hands. So and also this earning 60 to 70 lakhs at the earliest is something very vague. So again, I don't have a one-line solution to that. But what he can do is begin by saving at least say 25% of his income to begin with in say some good equity mutual funds, you know, for those financial goals which are there for 5 years or beyond. You know, so because that is a good way to participate in the equity markets without really doing trading. But for shorter term goals, I mean, I think it's better if he just relies on either an FMP or a bank FD, or so he has to have a good asset allocation for each particular goal. So I feel that's a better way. It's a very dull answer, but that's the way it is.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, Pradeep, the reason that we are giving, as Jen says, a dull answer is that the show is essentially about planning for your future, planning, making a cohesive and comprehensive financial plan for your long-term investment and your long-term growth strategy. Remember, we sincerely believe there is no shortcut for earning money, and it's if it's your hard-earned savings that you're talking about. Equity market is a place where you should be invested in a long-term period of time. That's our view. If you know everything about the equity market, if you are completely aware about the various movements, etc., like the experts that are there who are constantly sort of involved in a market, then you can play a role of a trader, and then there is a different call, and then there is a different strategy altogether. But if you're looking at making a lot of money and making and growing your money, and you are not really in a profession of a trader, then a word of caution that take care of your money and don't just base it on tips or so. Well, on that note, we'll end the show here, but we'll be back again for our next episode, taking another step of learning. Meanwhile, you please keep sending us all your queries. We'll be happy to answer them, and also please do get on to us on Twitter, and the details are mentioned on the screen. Thank you so much.
The Financial Planner, presented by the Bombay Stock Exchange.